Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's early morning, Tuesday, August 11, 2015, and today's all-important audio blog is titled, "The Endgame Starts as China Devalues the Yuan." Well, it's a special edition audio blog this morning to be followed by the taping of my newest USA Watchdog podcast with Greg Hunter. Why the urgency, you ask? As most of you are well aware of by now, one of the most important, fateful financial announcements of our lifetimes emerged last night, which, when all is said and done, may well be the straw that broke not only the gold cartel's back, but that of the entire world economy. However, before I get to it in detail, I just want to share a conversation I had late last night with Miles Franklin's president and co-founder Andy Schectman, who, as longtime readers and listeners know well, has long espoused that the precious metal industry's inevitable closure, and with it the ability to protect oneself from the inevitable hyperinflationary end of history's largest fiat Ponzi scheme, will ultimately be due to an inability to procure product. As an industry, we certainly witnessed this in late 2008 when all global mints shut down for months, yielding 30% gold and 100% silver physical premiums. And even 2011 when silver briefly reached $50 per ounce, cleaning out inventories the world round. The same occurred during non-crisis moments in 2013, following the April 12th to 15th alternative currencies destruction raids, as well as in early 2014 and heck, last month, when the U.S. Mint was forced to suspend Silver Eagle sales due to overwhelming demand, which, by the way, was on fire before last night's announcement, as despite the 2-week shutdown, U.S. Mint Silver Eagle sales had their strongest July ever, whilst in the first 10 days of August, a whopping 1.9 million Silver Eagle ounces have been sold, putting it on pace to be one of the Mint's biggest Silver Eagle sales months ever. And again, this was before last night's historic announcement. Anyhow, in speaking to Andy, he said Miles Franklin's silver inventory has been all but sold out, with nothing left for immediate delivery except 100-ounce bars and a modest amount of beautiful Perth Mint funnel spider coins, the latter of which, I might add, I'd be shocked to see still available by the time this podcast is posted. As for all the other silver products, junk silver, which in my September 2012 article, Must Own Junk Silver, I deem the most likely to become the most valuable silver product on the planet, given its status as the ultimate fear asset, is now nearly impossible to procure, with premiums sitting near record highs for weeks now, with no sign of a give whatsoever. In fact, I've watched the website of one of our major competitors like a hawk for weeks now, in which they always claim to have just one $1,000 face value bag, i.e. roughly 715 ounces worth of silver in inventory. And I've got to tell you, I don't believe it for a second. As for U.S. and Canadian mint silver products, they are now running at a 2 to 3 week delay, and in Andy's words, the physical silver market has become like a straw that has become so tightly wound up, one prick could break it, plunging us back to the aforementioned 2008 silver shortage situation. Again, I'm not talking about last month's 2-week mint suspension, but potentially months on end with soaring premiums and delivery times. As for gold, product availability is still strong. However, as we saw in 2008, particularly when silver supply dried up, that can change in a hurry. In other words, the time is now, following an historic 4 years of price suppression, in which prices were dramatically smashed down whilst the global economy collapsed, debt exploded, and the final currency war went nuclear, to protect yourself from what's coming, especially following last night's catalyst, which I predicted not only 3 months ago, but in yesterday's must-read article titled, "The Upcoming Cataclysmic Financial Big Bang to End All Big Bangs," which, of course, was Google's decision to change its name to Alphabet. Oh wait, no, that's not it. Oh, it was clearly the Troika agreeing in principle to give Greece its $95 billion bailout, as widely expected, pushing Greece's reported debt-to-GDP ratio to 200%, an actual ratio closer to a world-leading, economy-destroying 300%, given the roughly 300 billion euros of off-balance sheet debt we just learned of last week. Oh wait, that's not it either. And by the way, if I were an odds maker, I wouldn't even give Greece 9 months before it, once and for all, defaults on all of its soon-to-be 700 billion plus euros of debt and Grexits from the Eurozone, particularly once the relatively moderate Syriza party is driven out in favor of far more dangerous radical politicians. And not in Greece alone, by the way, in all of Europe. But I digress from the real reason for today's special audio blog, which, per today's title, was last night's historic PBOC decision to devalue the yuan in what they laughably deemed a one-off adjustment aimed at, quote, keeping the yuan stable at a reasonable equilibrium level. Yeah, 2 decades of strict pegging to the dollar with barely a movement at all, yielding the commandeering of nearly all the world's manufacturing market share, the world's largest trade surplus, $2 trillion of recycled U.S. Treasury bond holdings, and the U.S. government labeling China, in the ultimate pot-calling the kettle black pronouncement, currency manipulators. And subsequently, the PBOC wants us to believe a mere 1.9% overnight devaluation brings the dollar-yuan relationship into, quote, equilibrium. Or that, better yet, it will be able to control trading of the so-called offshore yuan, let alone the non-deliverable yuan futures market, which, as I write, is projecting at least a 5% devaluation over the course of the coming 12 months. No, this couldn't be more the polar opposite of a one-time adjustment if it tried, as clearly per what I wrote in May's ugliest economic data I've ever seen article and yesterday's upcoming cataclysmic financial Big Bang to end all Big Bangs. China's export industry is in all-out freefall, as are its financial markets, historic PBOC intervention notwithstanding. Consequently, the Chinese government did exactly what I predicted they would do, which is take the final currency war I wrote of back in January 2013, nuclear. And given the U.S. has no more manufacturing industry to speak of, having lost it long ago to China and other low-cost producers, the impact is being seen more emphatically in Asian currency markets, with the Japanese yen on the verge of a new 12-year low, as the market bets that Shinzo Abe will respond to the Chinese by expanding Abenomics to, for those that have seen Mel Brooks' Spaceballs, ludicrous speed. In other words, the endgame of history's largest, most destructive fiat Ponzi scheme is upon us, as all global central banks are now actively engaged. Well, all but the Fed, at least overtly, as despite holding interest rates at 0 for 7 years to suppress the dollar's value, it continues to comically pretend it has ended QE, despite the fact that someone has clearly bought the nearly $200 billion of U.S. Treasuries the Chinese have shed in the past year. And better yet, it continues to pretend to consider raising rates sometime in the near future, despite commodity indices plunging through 2008's lows last week, the labor participation rate at essentially all-time lows, all-time low wage growth, nearly negative GDP, and all signs that such hideous economic situations are dramatically worsening. And did I mention the $500 billion of collapsing junk bonds and leveraged loans underlying the imploding shale oil industry? Or next year's elections? Or, oh yeah, last night's historic yuan devaluation, which will only push the Fed to more dramatically devalue the dollar to prevent what's left of the business of America's multinational currency-sensitive corporations from evaporating into the ether? And this with essentially direct orders from the White House, which on multiple occasions this year have warned of the damage a strong dollar is doing to the economy. Which, by the way, is what I have vehemently warned of in my 2014 predictions from December 2013, when I forecast a collapsing global economy would not only foster an accelerated currency war, but a liquidity vacuum that would take the dollar dramatically higher, just as it did in 2008. Comically, we were last week propagandized that because Atlanta Fed President Dennis Lockhart said a near-term rate hike was appropriate, despite horrific across-the-board economic data, that the Fed was actually getting ready to raise rates, even if just by a modest 0.25 percentage point. Which, by the way, I debunked in this past Saturday's Audioblog. Oh no, the Fed's going to raise rates and crush gold, particularly in light of Friday's horrific July NFP jobs report. And yet, just yesterday, that same Dennis Lockhart gave a speech in which nary a peep about the so-called September rate hike the entire Wall Street Washington propaganda machine has been hinting at emerged. Clearly, he was either lying last week or plain old misdirecting with such hints in true Federal Reserve pretending we're considering rate hikes form. As for yesterday, equally clearly the Friday jobs report caused him to back off his supposed hawkishness, and more likely, in my view, the Fed had been given advance notice by the PBOC of last night's upcoming announcement, which, as I just noted, will not only cause the Fed to pause in considering whether it should raise rates, but more likely will push Whirlybird Janet closer to the inevitable Yellen reversal I spoke of last fall, when the Fed joins the currency nuclear war by devaluing the dollar further via negative interest rates and/or a massive QE4 announcement. And given this morning's horrifying post-PBOC commodity plunge, with oil giving back all of yesterday's manipulated dead cat bounce and base metal prices in free fall mode, the odds of said reversal just surged exponentially higher at one fell swoop. And oh yeah, free falling interest rates. Just as was the case when the Swiss National Bank devalued the last remaining strong currency, the franc, not so strong because it had already sold most of its gold, on September 6, 2011, with dollar price gold trading at its all-time high tick of $19.20 per ounce, the gold cartel was there last night to viciously attack the second this wildly precious metal bullish announcement was made. How do I know this? That is, aside from the blatant counterintuitiveness of precious metals falling amidst the initiation of a supposedly surprise launching of a global currency war. Not to mention when no other market initially budged, including Chinese stocks, because coincidentally it occurred at nearly the same minute as July 19th's Sunday night paper gold massacre was launched, in which gold was smashed by $52 per ounce in 1 minute in ultra-thin markets with no news of any kind and no other markets budging. Still, gold recovered its initial $12 per ounce loss last night, and red-hot silver its far more modest losses during Asian trading, with gold rising as high as $11.15 per ounce in early European trading. Of course, the same cartel herald capping algorithm as we saw Friday, yesterday, and essentially every trading day for the past decade was there to cap again at 4 a.m. Eastern Standard Time this morning, and when gold again surged to $11.14 per ounce later on, again at the 8:20 a.m. COMEX Open. In other words, the powers that be are terrified at what precious metals are signaling heading into a New York Stock Exchange Open in which stock futures are lower, commodities are collapsing, and the outlook for global currency war and economic collapse as ominous as at any time during the 2008 financial crisis. In fact, the yuan has not been allowed to fall this sharply since precisely that horrifying time in late 2008, which in hindsight, in my view, will be one day viewed as the good old days of simple deer in headlights temporary economic weakness, as opposed to today when global debt has exploded, commodities imploded with no hope of reversing, other than hyperinflation of course, and central banks cumulatively rendered futile by the bloated balance sheets that clearly have produced nothing but collapsing financial bubbles, historic wealth disparity, exploding social and geopolitical tensions, proliferating secession movements, and historic global currency collapses, which with today's historic Chinese announcement have just gotten started. And by the way, as the New York Stock Exchange is open, gold is back up to $11.10 per ounce, silver $15.26 per ounce, and commodities in free fall. As for the supposed U.S. recovery and pending Fed rate hike, LOL. Look no further than yesterday's news of collapsing U.S. train freight traffic and household spending expectations if you want to see what's really occurring, and free-falling crude oil prices to see what's on the near-term economic horizon of destruction, despair, and ultimately the aforementioned Yellen reversal, which, when it inevitably arrives, and frankly last night's PBOC announcement just upgraded such likelihood solidly into the imminent camp, will herald the final decisive endgame for history's largest, most destructive global fiat currency regime. And one more thing before I go, which I give kudos to my good friend Turd Ferguson, aka Craig Hemke, for uncovering, i.e. that following last month's comically fraudulent Chinese announcement that they only increased their gold reserves by roughly 600 tons in the past 6 years, which by the way is nearly the amount that Chinese miners mine each year, which the government purchases all of, they announced last night that they actually increased their gold holdings again, which I'll get to in a second. And again, not only do the Chinese miners produce nearly 600 tons a year, actually closer to 450, which never leaves the country, but thousands of tons are objectively seen to be imported into Hong Kong each year and delivered from the Shanghai Exchange into people's hands, not to mention entering unreported into the new Shanghai and Beijing free trade zones. But again, I'm not here to lecture on what we already know, or that back in May, when much of the precious metal community was expecting a big announcement of massive Chinese gold holdings, that I alone claimed otherwise. To wit, in my When Will We Learn of China's Massive Gold Hoard article of May 5th, I wrote, quote, the odds of the Chinese government, unprompted and uncatalyzed, simply coming out and saying, yeah, we have 20,000 tons, are about the same level as the CFTC coming out and saying, yeah, gold and silver are legally suppressed by JP Morgan. And how about that? Listen to what I had to say directly afterwards. Quote, instead, I believe a more likely scenario is that the next major financial crisis, likely the big one that destroys the world's largest fiat Ponzi scheme, forces the Chinese to defend themselves and their crashing currency by announcing their massive gold reserves. Perhaps this may actually be somewhat planned if an exploding dollar, due to the global fear-based flight to liquidity, forces the PBOC to depeg the yuan. If this occurs, the most likely market reaction would be a plunging yuan, which in turn would force the PBOC to slow the yuan's descent by announcing its massive gold reserves. Either way, the global ramifications of such an announcement would be so powerfully negative, the Chinese economy, already on death's door, would be dramatically weakened as well. And thus you can see why such a scenario is decidedly not desired by the Chinese government. Not desired, no, but certainly inevitable. Once said endgame starts and the currency wars go nuclear as they did last night. Which is why it's so interesting that just last weekend, the Chinese quietly increased their reported gold holdings by an additional 1.5% to essentially zero fanfare. In other words, now that the cat's out of the bag, that indeed they are acquiring gold, they are going to continue increasing the reported amount, likely in concert with the continually devaluing yuan, so as to stabilize its fall. Until inevitably, as I suggested above, markets become so unglued, like the yuan for example, that they are forced to report the reality of gold holdings so vast, even much of the precious metal community will be taken by surprise, which given the pace the global economy is collapsing at, could be far sooner than most could imagine. Perhaps in line with Gerald Celente and Egon von Greyer's by year-end forecasts. Consequently, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint and can help not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. All we ask, particularly in light of all the fantastic, free information our blog supplies you on a daily basis, is that you give us a call at 800-822-8080 and allow our staff of professionals, on average, sporting 22 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.